All right, everyone. Welcome back. This is DCF workshop number 2. I've recreated the DCF that we made last time. I lost it due to a file wipe on my work computer, but here it is. So just to recap what we've done so far, it's kind of the most tedious part. I did this on the couch last night, is we took the 10K and we went to I took the 5-year income statement here just because, but you basically go down to their consolidated statements, financial statements. And then you come here, you copy in the income statement, you copy in the balance sheet, and then you make sure everything sums up, right? And then you make sure everything ticks and ties. You add a balance check. So assets need to equal, total assets need to equal total liabilities and stockholders' equity. And then you have net income leading off your cash flow statement. And then all the way down, net cash provided by operating activities and, net cash provided by investing activities. And then net cash provided by financing activities. And then, so here we are, we're all set up. And then I put a couple KPIs here. So this would be comp store growth, comparable restaurant growth. Okay, cool. So like the first thing that I would do here is project the income statement forward, because that's kind of the easiest part. And these are sums, right? So I've taken my own spin on their income statement, and we discussed this last time, where they just basically say total revenue minus restaurant operating costs, and then they have general administrative depreciation and amortization, pre-opening and impairment closure. So what I did was I took revenue minus their restaurant level costs, their operating costs. And then I'm just putting in this thing called restaurant level profit, because to me that probably is useful. And then what we should probably put in here is percent of revenue, right? So they're making, if I'm just guessing, having lived through this, I think this was the E. coli thing. They saw like a bunch of like sales declines, and then obviously they have to keep operating the store, so their margins go down. It's relatively fixed costs, and you guys are going to see why restaurants aren't a great business. So then we take out G&A, which is like corporate expenses, like the CEO, accounting, like all these things that need to be centralized. And then depreciation and amortization, it seems like that's summed up here. We want to tick and tie that to this D&A, 163. Okay, so it does. But what I forgot to do is I want to make sure all of my units are all the same. So what I had done on the income statement is this is all in thousands, and I did it in millions. So what I'm going to do here, just for simplicity's sake, so this is in millions and this is still in thousands. And we talked about this, but you go 1,000, comma, and then on the blue, Alt ESI, which is divide, right? I want to divide these things by 1,000. And I'm just going to do that here. And then you can press F4 just to kind of copy it. That F4 is repeat the last function. So that's what I'm doing here. And here you see we're balanced. And then I'm going to keep doing that down here towards the cash flow statement. I mean, this is all stylistic, I think personally, I like seeing more rounded numbers. As I get older and not having to conform to a pitch deck format. But again, you can make it in thousands if you want, and they're all housed within here, right? So now it's just point something, point something, point something. So saving that. So what we want to do is initially, let's just what I like to do format wise is I like using this dotted line to signify a assumption, right? So percent growth, if you see this growth, right? Can you guys see my screen okay? Like it's clear and everything? Maybe like that, it's better. Yeah, okay. Okay, so let's just assume for now, right? Like we don't want to drive the model like this, and we talked a lot about that last time, but we just want to put like placeholder numbers here, just so that we can drive this and hook it up. So equals the last year's times 1 plus the growth rate, right? And then you want to, right? So that's that. And then this, obviously you got to change the formula for the last one, and then you copy that, right? Control R, that's what I'm doing. Okay, so that's that. And then, so that's percent revenue growth. And then we're going to do percent of revenue. So food and beverage and packaging costs as a percent of revenue. So like, how much do you spend on the actual burrito and wrappings and cups per burrito? And it seems like 33%. So we're just gonna, again, these are just dummy numbers. Again, chime in with any questions at any time, because some of this is just watching me hook some stuff up. So copying that down. What I've done, so I'm going to lock this, just, I mean, this is just experience, or I'm going to lock this because I know I'm going to use this again, percent of revenue. So I'm going to do this. So when I copy that down, the blue is locked, right? You see that? Cool. Again, slow me down if I'm ever going too fast. And I'm just, again, dummy numbers. Let's just say they grow up at 5% and all their margins stay the same. Occupancy costs, we talked about it. You can't, like, rent is not a variable cost, it's a fixed cost. So like, no matter how many people come in the door and buy burritos from Chipotle, they still have to pay X dollars in rent per month to their landlord. So what we're going to do here is a lot of rent leases have like an escalator in them. So that's why like rent per store grows. Also, as they open up new stores, right? They take out new leases at higher rental rates. So that kind of blends this per restaurant unit up. So last time we talked about how they spend about $142,000 per store in rent per year. So that means they're paying whatever that is. They're paying $12,000 a month, $12,000 a month. So what we're going to do is grow the per store number by whatever, like there's just the dummy number we have. And then what we're going to do here is how much do we actually pay in rent that year is going to be equals that times the average number of stores during that year. Sorry, average number of restaurants that year. So that kind of leads me back to here. I missed this. We should have started here. But let's just say end of period. So we got to go openings, closings, right? And then if we go, so clearly, let's just say they grow store counts by like 3% a year, right? Just say that, just dummy number. Equals that, right? So so this is the number of restaurants they had in the end of the period. So end of period. So if you ever see EOP or BOP, that means end of period or beginning of period. So I'm just going to assume that on this number, they open 3% of their stores, or times 1 plus that. This is just a dummy number, right? Just kind of carry that down. And then actually, let's say they open up 4% a year, but let's say they close 1% of their stores a year for a net growth of 3%. Does that make sense so far? Right? Like this is the number of restaurants they have at the end of each period, but during that year, they're closing and opening stores, and we want to capture that. Sorry, I keep calling it stores. Restaurants. Fine dining, Chipotle restaurants. Okay, so that's that. And then what I'm going to do is closings equals 1%, right? So times that. Sorry, this is the wrong. This was wrong. So it's that times that. So in any given year, so I'm going to round it because you can't have half a store, right? So I'm just going to round equals round to 0. So that the function here is going to say 4% of the previous end of period number of restaurants, but I'm going to round it to the nearest like whole number. So that's what I'm going to do here because you can't add half a store, half a restaurant. Keep doing it. So that's what we're going to do. So according to these dummy assumptions, in 2020, they opened 105 restaurants a year in 2020, and they closed 26. So we go equals that one plus how many do you open minus how many do you close? Make sense so far? Take that as yes. And then so you just got to hook it up because obviously we have a little, well, you know, you can make it easier by doing this and then adding the space later. Okay, cool. And again, we'll hook up revenue later. So what we have here now is what we're taking is per restaurant rent per year times the average number of restaurants that were open during the year. Because as we open 105, we can't assume that all 105 were open for the full year. So generally on these kind of unit economics types of models, you want to like assume the average over the period. Like that's just kind of a concept. Like we're assuming that the 105 get opened kind of smoothly over the year. And mathematically what you're doing is you're multiplying half of this times the full amount, or you can think about like the inverse if you want. Anyway, occupancy costs, kind of the same thing. I'm just going to grow it like what I think inflation might be, you know, I don't know, but you saw this growth, but then that was kind of a pop after these three. So just call it 3%. Copy this formula down. And then, so we're going to use this formula again. So we want to lock the number, which is the rows, not the columns, right? So that we can copy it right and left, but we can't copy it down. So what we're going to do here. So when we did that, right, we copied that down here. This moved with us, but this didn't. So just little time saving tips that, you know, it's the difference between 12 a.m. and 3 a.m. Cool. What do we got here? That's interesting though, that the margin would decrease over time when revenue this is because we're opening stores. Okay, so G&A, it's kind of one of those things that's a little bit harder to project because it's, you know, it's not directly tied to the business. It's like accounting and legal and all that stuff. So just smooth it out. We want to, again, we've had this thing before, this growth. So I'm going to copy the formula since we've had this growth formula before, and then I'm going to copy the format. And then D&A, just for now, let's just assume it's a percentage of revenue, which is kind of what you're taught early on. It's simplistic and rarely how it goes, but just do that. Huh. So corporate level profit, let's copy this down. Okay, so and then pre-opening costs. It's kind of interesting. We don't really know. We'll have to, here, Rayhan is. Cool. So we'll come back to this. It doesn't really matter for now. Maybe we can find it in the filing right now. So openings. Okay, so we do have it. So beginning of period openings. So let's copy this number. If I haven't copied it already, which I haven't. So we had 140 openings in 2019, 137 in 2018, 183 in 2017. And again, this is more complicated. It does seem like they have some experimental pizzeria locale, Tasty Made in Shop House. I don't know what that, I've never heard of those, but let's just take, so 9 closings in 19. Whatever this is. Four closings in 18 and 25 in 17, if I can do math. Yep. So let me see if that foots. Equals this plus this minus this. Yep, it does. It does foot. So when in doubt, just kind of, if it foots, make sure it foots first. And then now we can do that. Cool. So now we know how many openings and how many closings. So we want to drive pre-opening costs, obviously, as how many, like how much per opening does it cost per opening? So it costs, sounds like it costs like 40 grand to train a bunch of people divided by when you open a restaurant. Oh wait, well, obviously not. So yeah, and I'm not going to do the average thing because I'm just going to assume that 140 were opened and pre-opened and trained. Okay, so it costs like 62, 70-ish thousand, 70 to 80,000, 60 to 80,000 per Chipotle you open. You have to like do all these pre-opening costs to like get it ready for opening. So I'm just going to assume, let's assume that's a growth rate. So we kind of did the same, it's the same concept up here, right? So I'm just going to go like that. Equals that times, right, openings. So if we're assuming there's openings, there's going to be opening costs associated with them. And just let's just assume, given all the money printing, we're going to see 3% inflation going forward. Okay, cool. And then kind of the same thing, right? So per closing. Up to closing. Okay, so it seems like it's costing, I mean, it doesn't seem interesting. Yeah, maybe we should do an average because you see this, there's like a big spike on impairment and closure costs in 2018, and we've seen I guess we could just leave it for now. Let's just assume there's an average of, it takes $1.5 million to close a restaurant. I mean, that doesn't sound crazy. Like just thinking about if you have to close down a Chipotle store. So let's just say that's like 1.5 million. Grow that by, and I know one of you asked about, or one of these times, when I'm formatting, it's as I told you then, it's kind of hard to explain. It's just like as you go. So 1.5 times the number of closings you have, you get some number of, cool. And voila, we have a operating income number. Let's get an operating profit, operating margin. I'm going to relabel this as restaurant level margin. Okay, cool. So we're almost done here. Interest income, we'll get to that a little later. And income taxes, we're going to just kind of do one of these things. Effective tax rate, and just kind of see what they've been having previously. What I like to do with percentages is 0.0 underscore close parentheses, or yeah. And then semicolon. So this governs what positive numbers look like. And then the second one after the semicolon governs what negative numbers look like. And so negative numbers, obviously I like this, but there's no pre-stocked Excel one. So what we're after is when it's a negative percentage, I like it in the brackets. And then you add this to the end of the positives so that it aligns with the negatives, and then kind of do that. I don't know how else to explain it. So this is positive, and I added this underscore parentheses to have a space after the number so that it aligns with this. Because when a negative number shows up, this takes the space of a space. So we want the positive number to align with the negative number to align with the zero number. It's super minutia, and it's something I learned when doing pitch decks, but it's always stuck with me. Anyway, it doesn't even matter because I'm not going to have a negative tax rate. Oops. Forgot the percentage. There it is. Okay, so 23% tax rate. So do you all see where the Trump tax bill happened? We had a 35% effective corporate tax rate, and that went down to 24 to 25. So you see where that happened? Pretty cool stuff. So as you can see, who is in the White House and what their tax policies on corporates will be does affect post-tax cash flows, and it affects the valuation of such. So this implicitly implies, if we just say that all stays the same, it implies that we're going to see a Trump president's re-election. So, I mean, we can change it later. I'm not saying that I believe that. Just remember you have your positive, negatives straight. Okay, so what I like to do when I leave something for a later time is I just highlight it a really obnoxious color. So I know I have to come back here. And I also know I have to come back here because we want to drive revenue based on number of restaurants and percentage revenue growth per restaurant, which is what we call restaurant, like comp store sales or restaurant level sales. So I'm gonna like just highlight these two, come back later. Save it, good. Any questions? If you raise your hand, I can pause the recording and just do a little, unless everybody's good. Good? Okay. Also, feel free to chat me if you don't want to speak. Okay, so let's move on to the balance sheet. Yeah, let's move on to the balance sheet. So actually, all right, I'm gonna teach you the full 3-statement model. Okay, so we'll go to the balance sheet. So some of you, so I'm gonna rename this sheet operating. And then I'm gonna insert another sheet. That's a copy. So what I did there was Alt HOM. So I'm moving this sheet, but I'm actually gonna make a copy and move to the end. And so I have a copy of the operating model. And the reason why I wanna do that is because I wanna keep the formatting and what I basically have created. And what I'm gonna call this is drivers, like other assumptions. And some of you are asking, why do you drive things on a sheet or why do you drive things on another tab? The answer is, if you're going to be playing with it a lot and looking at what the difference is between your drivers due to the model, you want it on the sheet because you're going to be changing it a bunch. But for the assumptions that are there and like matter, but they don't matter as much and you're not going to be changing them a lot, you want, like, it makes a lot of sense to just either put them at the bottom or put them on another sheet. So what we have up here is we're just going to delete all this because all the income statement stuff, control negative sign. That's what I did. Delete that. I'm going to make a bunch of these balance sheet stuff. I'm going to drive it from here. So accounts receivable generally are driven by days sales outstanding. So just to remind you all the formula. Good old Investopedia. So like the concept of day sales outstanding is once you've sent an invoice or once you've made a sale, how long does it take for you to collect payment on that? Like, so if I'm guessing, Chipotle has a very, very short day sales outstanding because all their sales are like in person and all I have to wait for is like a credit card transaction to go through. So cash is just a plug on all these models. So you want to delete that. So accounts receivable, and to get a good view on it, right? We can actually do the formula where, where's the formula? Okay. So it's day sales outstanding equals accounts receivable divided by sales times the number of days. So these are year periods. So equals this number, accounts receivable, divided by revenue of that period times 365 because it's 1 year, right? So here we see it takes them like 5 days to collect. So, we want to go days sales. And so let's just kind of do what we did back there. Dotted lines are assumptions, and then just kind of, let's just say they just keep the same day sales outstanding. And so, right, if you remember how to do algebra, just like, so to find accounts receivable, we need to find accounts receivable, right? So you want to divide both sides by number of days, and you want to multiply both sides by total credit sales. So let's divide it by number of days. So, right, so you get DSO time, well, let's do it, times credit sales divided by 365. That should get you your number. Cool. Oh, I don't even have Macabacus in here. It's stupid. Oh, okay. So we made a mistake here. I wish I had Macabacus. Hold on. All right, whatever. H20. Yeah, so this needs to be I20. Yeah, so 2020, right? Because it's that. Okay. So, and you copy that right. So do you understand that though? So basically, days sales outstanding is a formula. You can look it up, days sales outstanding or accounts receivable days. And it just tells you how many days it's taking them to to get the money once they've sold something. And then in order to kind of, we project days sales outstanding going forward. Like if you have an opinion on, oh, like everyone's going to pay with Bitcoin going forward, so transactions are going to be instantaneous and there's no like payment processor wait time, then you can project that to go down, but I don't have that view. So, and then you arrive at this number again by just inverting the days sales outstanding and solving for accounts receivable. So just using basic algebra. Inventory. So, inventory to me is usually done as a percentage of sales, because like the more you sell, the more you kind of have to keep in storage or in inventory to sell. So well, copy this percentage sign. Okay, that's actually pretty surprising that they don't keep much inventory. I guess they must get fresh food and use it that day. Interesting. So what I want to do here, though, is operating model H20 is I want to lock this because we're working on different sheets. And as you can tell, the reason why I love staying on one sheet is because like going back and forth, even though I'm fast, it's, control page up, page down. It's still like mentally, I just don't remember what was on the past sheet. And this is the reason why I copy the other sheet here. I'm not making any changes so that everything's apples to apples, so I can copy right, copy left. So again, like that, we're just kind of assuming that inventory as a percentage of revenue stays the same, and you're just going to go equals 2020 times that. And then again, I'm going to do the same thing, lock the cell. Because I'm going to drive a bunch of other things like that too. So, and this is the extra tedious way to do the DCF. A lot of times what I'll do, like what I've done at hedge funds, is you combine all the current assets and you combine all the current liabilities, and you just assume that that's just one line item as a percentage of revenue, which would be like your net operating working capital. But I mean, we're just gonna go for a 3-statement model. Same thing with prepaid expenses as a percentage of sales. Why don't we just assume that's the same? Okay. And the reason why I locked all these cells and was careful about them is so I can copy down really easily. Income taxes receivable. I mean, I guess we could do it as a percentage of post of let's do it right. Percentage of EBT, which is earnings before tax. Taxes. So let's just go equals this divided by earnings before taxes. I mean, it's not really going to make a difference, but again, you want to tie your drivers to the closest thing that they're related to. And then just assume it's the same, equals earnings before taxes times that number. And in reality, this could probably zero out. This might be some tax refund that they're waiting for, and it'll come, and but we'll just be conservative because we don't really know much about it, and we can read about it and like have a view on each one of these items. And investments, I don't know why they'd have investments, so let's just look it up. Okay, so should be under income tax receivable. Okay. Our trading securities carried at fair value, held to maturity. I don't know why they have them. So it doesn't, they're not really telling us what they are. So what I'm going to do here is just keep it the same because I have no view on it. And I don't think it's part of the core business. They're just keeping random market investments there. Well, whoops. So to see, always check your formulas, and that's why F2 escape is so important. So I'm holding down control and clicking the ones that are actually applicable since we split this out, because over here, we could kind of sum up the whole thing, but here we split it out because we're driving them. Okay. Okay. This is PP&E, and we're going to drive this later. So what I'm going to do is highlight. Restricted cash, that's the percentage of revenue. Operating lease assets, percentage of revenue. Operating lease assets. Well, let's look at it. So this means that they've prepaid a bunch of rent. You know, I don't know how necessary that is for operating the business. But these are long-term assets. So what I'm going to do here is just for these long-term assets, a lot of times you just kind of like keep them on the balance sheet unless you have a view of why they shouldn't be on the balance sheet, because so we're just going to do that. Okay, so we're not going to actually do that here. So I'm going to delete that because we're going to do it out here. If you remember, this is supposed to be our assumptions sheet, not our actual model. So what we're going to do here is equals just, oops. And just keep these the same. And what we can do now, so we're going to come back to cash too. Remember, we deleted that. So what we can do now is start hooking things up. So equals accounts receivable right here. Boom. And if you remember, color coding is important. green, this dark green usually means it's pulling from another sheet. Okay, so just gonna equals inventory. We did inventory here, equals prepaid expenses over here, equals income tax receivable over here, equals investments, just keeping that the same. Okay. Okay, cool. So let's keep going. You guys have any questions? I can take it offline if you need it. Okay. Alrighty. So we're back on our assumptions page. Let's not get lost. So accounts payable is kind of the opposite of day sales outstanding. It's AP days or accounts payable days payable outstanding. And it's basically the same thing, except it's not on sales, it's on cost of goods sold. So, but it's basically similar to days sales outstanding. We'll bold these at where we're driving. Similar to days sales outstanding, days payable outstanding is how long it takes Chipotle to pay their vendors. So if they order a bunch of chicken, you know, how long, okay, so I'm going to cut this. So it refed out because I cut that. I'm going to do this because we're keeping that the same. So account like days payable outstanding. So we're going to copy this. DPO is how long does it take for them to pay their vendors? So it should be, you know, this formula. It's equals accounts payable times, or well, this uses what we did last time, divided by, so instead of revenue, it's kind of costs of goods sold, but we don't really have like a true COGS here. So what I'm going to do is just lump in all these restaurant level costs. So obviously I need to sum these, and then times 365. So it takes them an average of, if I'm reading this right, yeah, so like 10 days to pay their vendors. And it takes them 5 days to receive the cash once they sell a burrito. So again, kind of let's do the algebra in your head. It would be, we're trying to solve, if we assume days payable outstanding, we're trying to solve for accounts payable. So that's going to be DPO times COGS, or well, times sum of this, divided by 365. Did I do it again? I did it again. Equals this divided by, this times COGS on 2020. Sum divided by 365. Okay, there it is. That's the right number. Okay. And I'm gonna make these green because they are pulling from another sheet. Forget exactly if this is kind of an edge case. It pulls from another sheet, but it's also a calc, which I just like putting green just in case. So again, that's that. And then accrued payroll and benefits, accrued liabilities, unearned revenue, current operating lease liabilities, income taxes payable. Well, so they don't have any income taxes payable, so I'm just going to delete that. Accrued payroll and benefits, I'm going to do that as a percentage of labor costs. So percentage of labor costs equals this divided by that. Okay, 8.6%. Pretty clean. Actually, yeah. I don't think that these are supposed to be green. It's been a while. So now equals this, or equals labor costs 2020. I keep having to remember that. Labor costs times percentage of labor costs. Cool. Accrued liabilities, you know, I'm just going to do percentage of restaurant costs equals this divided by sum of accrued, just all these costs. Okay, how much you looking? Are you guys seeing this? It's weird. I'm going to lock these because I'm going to use it for the next one. Well, actually I won't. So 3.5%, do the same thing, but remember to change this equals this times sum of 2020 costs. Unearned revenue, I'm going to do as percentage of revenue. So we already have something like that, right? We locked that cell. So percentage of sales, we're just going to copy that down. If I had Macabacus, I would check it, but divided by H20, okay, that's fine. Equals that times, well, we have that already too, percentage of sales. There it is. Okay, cool. Other current operating lease liabilities, I'm just going to keep that flat. Deferred rent, keep it flat. Long-term operating lease liabilities, I'm going to keep it flat. Well, see, yeah, like it jumped to something big, so I'm just going to keep that flat. I'm going to keep this flat. I'm going to keep this flat. So all these things are like, we can drive them individually. They're just a bit immaterial in my opinion. And so I'm just going to delete that. So those are a lot of our complicated ones. So we're back. So I'm flipping back to the operating model. And so let's just fill in the accounts payable part. Accounts payable. We have this. Accrued payroll and benefits. Accrued liabilities. Unearned revenue. Current operating lease liabilities. I told you I'm just going to kind of carry that forward. Income tax payable, just carry the 0 forward. And then deferred rent, carry the 0 forward. Long-term operating lease liabilities, all these I'm just going to carry forward. I mean, we can look into it really deeply if you're going to go really deep and you're like going to cover the company, but let's just focus on this. Common stock, what I'm going to do is, this is all well and good and nice, but what we're going to do is we just usually I've seen, we just lump all equity into one kind of plug. So we're going to come back to that. And then we carry that forward. So we're going to come to that. And obviously we're not balanced right now because we don't have cash, we don't have PP&E, and we don't have shareholders equity. Okay. So that was the balance sheet. Do you guys understand what I did? I know I wasn't super good at explaining what I was doing, but please raise your hand if you have any questions and I can pause it or whatever. Nope. Okay. All right. So we have this other assumptions tab where we're driving balance sheet assumptions. So now we have dummy income statement assumptions. We don't have interest income. We have yeah, and then so now we have to do the cash flow statement. Okay, cool. So the concept of the balance sheet is to reconcile accounting accrual, like accrual accounting on the income statement, where things can be expensed, but there's no actual cash outflow, or things are earned, but there's no cash inflow with just cash, right? So as investors, like we don't really love the concept of accounting. We love the concept of how much cash does this business bring in to the door every single year. Excuse me. I was talking to myself, makes me thirsty. All right. So we start with net income. You'll see in simpler DCFs that you'll start with EBITDA, right? But I'm just going to walk you from the very bottom, right? So if you start with EBITDA, you're starting somewhere up here with like basically operating income plus D&A and adding back this. But yeah, so what I'm going to do here is net income. So I go up to net income and just that's that number. Copy that. Depreciation, amortization. I go up to D&A where so you want to make sure because sometimes not all the D&A is captured. So even if a company, because they don't always do this, but this company does, splitting out depreciation and amortization separately, that doesn't necessarily mean that's all the depreciation and amortization that you have to add back. A lot of times there's more. So the way to check is to check this number, the D&A on the income statement. So 212778 with the one on the cash flow statement, which reconciles it to cash. So 212778. So in this case, the D&A in the cash flow statement and the D&A in the income statement are the same. So we can use that. So equals, so we're going to hook this up back to this one line up here in our income statement. And just for you, us finance people, we're going to add just a special line for EBITDA, adjusted EBITDA equals, and I'm going to say adjusted EBITDA X SBC. So that's stock-based comp, which is not a cash expense, and X opening closing costs. So proxy for cash flow. So what we're going to do is operating income plus impairment costs plus pre-opening costs plus D&A. And the reason why I'm adding this back in this whatever adjusted EBITDA number is because conceptually the opening and closing costs are kind of like one-time expenses. So for those of you that want to see EBITDA, there it is. Okay, 26. Man, they've really, Chipotle's really fallen since 2015. I'm really curious. Hold on. Chipotle, E. coli, outbreak of 15. Okay. I remember this. People stopped eating at Chipotle around 2015, and then that obviously killed them for the next year. It's interesting. Anyway, amortization of operating lease assets. So each one of these lines are, so I'm going to tie this back here. So here's the cash flow statement. This stuff is all kind of in the kind of income statement that they're adding back, that's housed in the income statement. So just know that. And then everything here is kind of like changes in your, well, let me back up. This is changes in your like net working capital, which is like your current operating assets and operating liabilities. But it also, so in a standard cash flow statement, this bottom section here of operating activities captures the changes, the cash flow changes in the balance sheet, versus this is kind of like non-cash add backs that should be added back to the income statement. So just remember, income statement-ish, balance sheet-ish. Cool. So amortization of operating lease assets. I don't know where that would be. So let's look that up. So everything's in the footnotes. So if you ever want to read, if you ever have a question about something, they're usually in the footnotes. Deferred income tax. So obviously I need to do more digging on this one little item. But let me see if I can tie it out. So, okay, so 164. Is that on the balance sheet? Operating lease assets? No. That's 2505. Okay, so what I'm gonna, so this is, I think it's clearly, okay, so see, I think this is actually the amortization of this balance sheet item, which is operating lease assets, right? It's the amortization of operating lease assets. And what I would need to figure out at a later time is why this is so big. And I guess they started amortizing it that year. So what I would do is, since we're keeping this the same, basically what you need to do is, if it's on the asset side, if it goes up, that's a cash outflow. If it goes down, it's a cash inflow, right? So here, just make sure. So right now we're doing equals last year's asset balance minus this year's asset balance. So if we, for some reason, said that this was going to go down like 500, so 2050, then, okay, so maybe I did that wrong. Yeah, so, no, I did that right. So if a asset goes down, that's a cash inflow. If an asset goes up, that's a cash outflow. So if instead they just accrued more operating lease assets, this went to 3,000, that would be a cash outflow. You see that? So hopefully you've learned that before, but if not, I can explain that to you in detail if you have a question after this session. So basically, I'm going to do that for everything. Deferred income tax benefit or provision. Prepaid expenses, deferred income tax. Okay, so I think this is impairment. So we're just gonna assume stuff. Bad debt allowance. So we're just gonna delete this or just zero this out. I'll come back to the things that are a little bit more complicated. Stock-based compensation expense. So what we want to do here is we want to assume it on here. So cash flow statement assumptions. Try to keep this within 10 minutes, guys. Assumptions. So what we're going to do is assume this as a percentage of revenue. Well, I guess we already had something here. Percentage of sales. Okay, cool. So going back here, SPC, we're going to pull from our assumptions. Other, I mean, I guess you can do a percentage of sales. It's so immaterial. I'm just going to go, I'm going to zero that out. So here is what I was talking about. This is like the changes in your balance sheet items. And if it's an asset, if it goes up, it's a cash outflow. If it goes down, it's a cash inflow. But if it's a liability and a liability goes up, that's a cash inflow. And if it goes down, that's a cash outflow because you have to pay back somehow the cash. So, or you have to pay back the liability. So let's just do this really quickly. So equals, so if it's an asset, you go last year minus this year. So this one was accounts receivable. So it's an asset. Accounts receivable last year minus this year. So it went up. So we should have cash outflow. Cool. Inventory is the next one. So we can just copy that down. Prepaid expenses. This is the next one down. Other assets is right here. And so we want to go equals other assets minus that. So now we're in liability. So accounts payable. So it's the opposite, right? So it's this year minus last year, because if it goes up, it's a cash outflow. Wait. Oh, sorry. If it goes up, it's cash inflow. Sorry. So that was right. So it's this year minus last year. Counts accrued payroll and benefits. Next one down. Accrued liabilities. Next one down. Copying it down. Unearned revenue. Copy it down. Income tax payable, receivable. Okay, so they combine this. So equals income tax payable, receivable equals. So this is right. This last year minus, since it's an asset, this last year minus this year plus income tax payable is this year minus last year. Deferred rent equals last year minus, sorry, equals this year minus last year. Operating lease liabilities equals, well, okay, so it looks like they combined short-term and long-term. So it's current operating lease liability. So this minus this plus this minus that. Cool. And then other long-term liabilities. So we have to see what we actually, okay, so we've covered all of liabilities. You want to make sure you cover everything. So other long-term liabilities equals are just these last two. This minus that plus this minus that. So just making sure all of our liabilities are covered. Okay, they are. Let's see if all of our assets are covered. Not goodwill is not covered. So I have to cover that minus that. So it seems like a few things aren't covered, but we'll figure that out. I know we're running low on time. Cool. So looks like we're halfway through the cash flow statement, and we'll finish hooking this up next time. So thanks everyone. We're going to stop the recording, and we'll do another session next week. Stop recording.